Okay, let's get started for a look back and a look forward. My opening comments are basically a dovish Fed. And regardless, even if they're not dovish, the market, I think, is about ready to explode. And I think maybe next week may be a little gentle. Won't move much, maybe move down a little bit, but then I think after that, I think we're going to see some fireworks. But let's kind of take a look at really the whole week was Wednesday and Friday as far as the markets go. And if we take a look at the Dow Jones, it was an interesting week. I mean, we finished up for the week. And if you look back to what happened on a daily basis, you'll see that after the Powell, chairman of the Fed, Powell speech, that the markets were looking for some hope, and they got it from him, basically saying that he was going to be doing a 0.5% raise. And so you saw 1,000-point turnaround and 500 points in an hour on the market just based off of that speech. And I don't know that I would call it completely a dovish speech. I think he was saying how long he's going to do all these things, but I think the market's just had it with the Fed. I know I have too much control, and I think people are just fed up. And the fact that he gave or perceived to give somewhat of a dovish speech, but promising to keep the Fed funds rate up high whenever they get to their high point in the Fed funds rate. He's going to keep it there a while. I don't think that'll happen. There's a lot of things breaking in the economy, and he's already over tightened. I mean, it's just a mess. Since 2008, and with the quantitative easing and lowering the Fed rate, it's just we've got a huge mess of debt that I talked about last week. And then today, we got the jobs report. It's expected to be 200,000 jobs, non-farm payroll, and was 263,000. And the market immediately went down. I mean, all pre-market went down. I think it was about 450 points or so, and then wound up today up in the Dow Jones Industrial Average. You can just kind of look at the day, by hour, and it the market shook it off. Their 263,000 jobs, yeah, that should tank it. It did tank it. And then as the day wore on, I think people, again, are a little put out with the Fed at this point. And, even the numbers, there's some funny things in the numbers as far as 263,000 jobs. The participation rate was lower. And, to be honest with you, you've got a lot of baby boomers that are retiring, and there's going to be job openings, associated with that. So it's an interesting time as far as the markets go. And so I wanted to kind of open with that. If you take a look at the SPY too, S&P, and one of the S&P indexes, it wound up the week, up also. It's been pretty good for the markets. I think we're breaking some of the patterns we've seen in the downtrends now. I mean, I'm not going to put, line up this chart, but we're just outside of it. Now, it could go back down again, but that's not my expectation at this point. I think we're potentially going to get one of the greatest bear market rallies ever, or in David Hunter, who I've done an episode on. If his forecast comes true, he's looking at, see if we can get up there. What's his forecast? So it would be somewhere around 600 here. That would be, just put a marker around there. So 600 you know, and we're at 406. If his forecast comes, my expectation now is that and again, not a straight line there, but my expectation is that we'll see at least close to the all-time highs again before we have the collapse. Just have to keep an eye on the markets at that point. And I'm all price action trading right now on swing trades. So, that's kind of my expectation as far as what goes on. I think that the Fed, now there's going to be some key moments here, right? So I said next week will be pretty quiet. But let's kind of just take a look at, this week. Let's go calendar, and we go and we take a look at all the things that were primarily reported this week that mattered. Were the Fed chairman speaking, and if we also look at some of the other things, personal income is up. That number is going to be perceived as inflationary in the Fed's eyes. Let's see what else we got here. Non-farm payroll that we had today. There's the 263,000, the anticipated 200,000 that drove the market down earlier. And, that's pretty much it for the week. I mean, there were two things that drove the market, and that was the Fed Chairman Powell's speech on Wednesday, and then today the non-farm payroll reporting numbers. So that was pretty much it. And then, if we take a look at next week, well, let's take a look at one other thing here I want to take. 30-year mortgage, 6.49%. You can see it's on a decline, and that's going to be based off of the 10-year that I'll get into a little bit later. But those are the numbers that you basically saw this week. Two things drove it: the Powell speech and the non-farm payroll, and how the investors reacted to it. Let's take a look at next week. So next week, manufacturing, balance of trade. Yeah, there's not a ton here. Maybe later in the week, the PPI and the Michigan consumer sentiment. Now, something may happen during the course of the week, but those are really kind of the drivers of the market for next week. Pretty quiet week overall, as long as something weird doesn't happen with crude oil and those types of things. So let's kind of look at let's go back and look at investor sentiment first. Actually, people got more bearish. This is on Wednesday night when this report comes out. It's staying pretty steady here, 40.2%, 40.4%. Actually, the number of people bullish went down, and the number of people that were neutral went up. So we got a few people moving from bullish to neutral. And I probably would say for the next week, that's probably where I am, neutral to maybe even bearish, just because there's not much going on. But I tell you what's going to drive the markets after that are going to be, I don't know how you get to this. Let's take a look. About go back to next week. Well, the following week is when they make the decision. They, being the Fed, will make the decision on the 0.5%. That still looks like that's the consensus. Get a 0.5% up, a slowing in the Fed funds increase, and that's a good thing. People got excited about that, and there'll be some numbers coming out on the CPI right before. I think it's the day before that, so they'll have those numbers. As long as that does, if that number comes out, uh, you know, below consensus, then you can look for the markets really to go after that. But again, I would say next week probably pretty quiet. All depends on, unless we get some really real outlier, some weird international thing goes on. All right, so let's kind of, my final comments here are going to be based off of, so the 10-year is going down, the yield on the 10-year. This is a reason why the mortgage rates are going down. Is, you know, this number peaked out very high, got very concerned actually there. Something would really break. I think things have already broken, but we'll see. 3.488% right now, got below my 3.5% I was looking for. Next number I'm looking at is probably, really, we got a lot of activity around, well, 3%, potentially even 3.25. So those will be the next numbers I look for the yields to come down to. Now, it can pop back up. If it does, then obviously things like technology stocks like Apple will tank. We look at the DXY, another indicator that's kind of peaked out at 113 or so, and now we're below 105, which is the number I talked about last week. You know, I'm looking for it to break the next level and then, you know, work its way down. It's not going to all happen at once, but the fact that we're below 105 is significant, and kind of cools off the milkshake theory, at least for now. And it could pop its head back up again, you know, next week. WTI Crude for the week was up a little bit. So, you know, we're back about $80 a barrel. And let's take a look. The VIX is another indicator. It finally broke through 20. It's been threatening to do that, but if you look, it's right at the same levels that we've been at on a number of occasions back in, what was that, August 8th, the week of August 8th. Back in March 28th, we finally got the VIX down. It's an indicator of the volatility in the market. And, you know, it's the lower it goes, the amount you pay for things like options, the volatility is supposedly lower, the implied volatility goes lower, and so you don't get as much action going on. And obviously for traders, they don't like that very well because they like all the volatility of the up and down. Investors, not so much. They don't really like that. So that's really just a quick, short update on this past week. I look forward to next week. And the one thing I encourage everybody to do, again, is I put a link into some free training. It's not mine, but I think, you know, the link that you go to, Chris does a very good job of explaining the basics of options. I'll start to put some other free links out there of sources that people can get into. And, you know, I think that will help not only you as an investor, but your investor with your financial advisor. There are a number of tools out there to use. And just like anything else, you know, the more knowledge you get, the better outcomes you're going to have, because you'll ask better questions of your investment advisor, or if you're managing it yourself, you just become a better investor in general. And I think trading, to me, and understanding it, not necessarily having to participate, it would, at a minimum, make you a better investor. If you understand the tools that others are using around you. Trading is a crazy thing, especially people that do the day trading. If I do trading, you know, I've done day trading before, but not on purpose. In other words, I got into stock, it went way up, and I said, boy, I better get out. But swing trading, you know, where you hold a stock maybe 1, 2, 3 weeks, you know, looking at, you know, the movement of the stock and whether it's a good time to buy something or not, based off of resistance level, um, resistance and support, and there's a number of other patterns. There's some funny things associated with that. I may put a video together just on that piece with efficient market hypothesis versus technical trading versus fundamentals. But again, I think everybody needs to get knowledgeable. If you don't know some of the things that I've been talking about, yeah, like I said, I'll start adding resources in. I think options is a good way to kind of understand broadly what's going on because it involves technical analysis and depending on how you trade options, fundamentals, and when you want to hold something and what you want to hold, and and all those things. And if the expectation is that the market drops, and it doesn't come up for decades back to the whatever highs, and we may already hit it, then you're going to have to be a different type of investor because you're not going to get everybody always says, and I've said this before, well, the market always goes up. Well, I think that's going to get tested. And so I think becoming more knowledgeable in these things is a really important thing for everybody to do, especially people around my age. I'm in my 60s. So getting knowledge is especially important. I had some coming into where I've gone over the past few years anyway. And, I wish I had known a lot more. It would have made a huge difference, I believe, at least in my life. Other people might have maybe either more knowledge than me or maybe luckier. But regardless, it's something that if you're going to hold on to what you have or you want to grow what you have, educate yourself. And that's what I wanted to cover this week. So remember, there's always a better way.